James, you heard about what we've been talking about. How do you judge this quarter separate of this pop that we're seeing? Is it justified? Is it enough? Is it too much in the stock right now?
Yeah, thanks for having me. Certainly, from our perspective, Google's business model, Alphabet's business model, is a lot more resilient than its peers, right? We're seeing consumer shifting their spending very quickly to offline, to travel, and Google is able to benefit from that specifically. And at the same time, we saw cloud business remain pretty healthy. But keep in mind, there is a lot of macro uncertainty going into back half, especially into FY23.
Yeah.
So therefore,
James,
I think
expand.
the consensus in the risk here.
I'm sorry to interrupt you. Expand on the cloud business, because I did feel that there was a big difference between what Microsoft said about the cloud versus Google. The management team was pressed by analysts on the call to kind of at least just talk about what they're seeing in terms of demand, and they really refused to, versus that 40% plus outlook from Microsoft. How confident can we be about the trajectory of Google Cloud?
Yeah, fair point, right? They said they haven't seen any slowdown, but we have done independent checks. We did a survey with 250 CIOs, and they're indicating that they are anticipating a recessionary scenario, a shallow recessionary scenario, and they are planning to cut their cloud spending growth about 10 points. At the same time, our separate checks showing sales cycles are extended. And at the same time, some of the vendors on the cloud side are evaluating price concessions. And the reason probably we're not seeing any slowdown in cloud spending right now, because the lead time for implementation for cloud projects typically take about 6 to 9 months. If CIO decide to take any actions, it's going to be FY23 as opposed to FY22.
James, how much of what we're seeing out of Alphabet today is not a reaction to the earnings themselves, but a reaction to the fact that we didn't get a replay of what happened with Snap, right? Were people, some people anyway, afraid of what Google might say in terms of a slowdown, and that's what we didn't get?
Yeah, that's a fair point, John. All right. What happened with Snap, we think it's more company specific, right? And obviously, social media advertising is being more impacted due to macro. At the same time, we see quite a bit of competition from TikTok, right? We recently did our checks on TikTok. Specifically, despite the weak macro, John, they're still targeting to double their U.S. revenues from $2.5 billion to $5 billion. So obviously, they're gaining market share at the expense of some of the players in social media space.
So what does this mean, especially given that we had strength in travel and retail from Google in particular in this current quarter? What do you think that means heading into Q4? I wonder what's happening with retail inventory, given that retailers are just telling us, Walmart, it was 2 days ago, Walmart telling us that they're marking things down, trying to clear things out. Target having said that a couple of weeks ago as well. Maybe that exactly doesn't continue into Q4, and I'm not sure how great an insight these companies always have into exactly the reason why these categories are good.
Yeah, good point, John. We think the mix shift to maybe essential product into grocery and into travel, that'll continue into Q4. So we're not very concerned about search for this year specifically, maybe a little bit of weakness on the margin. What we're concerning, as consumer continue to be strapped heading to FY23, they need to continue to make choices, especially on travel, right? Or especially on services industry, entertainment in general. And that's why, in terms of advertising revenue for Alphabet, we're below consensus for FY23. The street's looking for 14%. We're currently at 9% at this point.
Shepard Smith here. Thanks for watching CNBC on YouTube.